Welcome to this explainer. Grab your Warren Buffett hats because today we are running a definitive, data-driven masterclass on First BanCorp. We're going to pull the raw, hard numbers directly from their Q1 2026 earnings reports, S&P ratings, and SEC filings to build a rock-solid value investing thesis. So if you absolutely love seeing qualitative competitive advantages get translated into rigorous quantitative valuation, you are in exactly the right place. Let's get right into it.
Here's our syllabus for today. First up, the business and moat. Then a deep dive into the financials. We'll run 3 distinct valuation models, lock in our margin of safety, and then finally deliver our investment verdict.
Starting with Section 1, Business and Economic Moat. Because just like Buffett, before we even touch a spreadsheet, we have to figure out if this company has a durable competitive advantage.
Okay, so what is First BanCorp? In a nutshell, they're a massive, deeply entrenched regional bank. They make their money the good old-fashioned way. They capture low-cost deposits, and they lend them out at higher yields. With about $19.1 billion in assets, they run a super predictable banking model across Puerto Rico, the Virgin Islands, and parts of Florida.
Now this is where it gets really interesting. Look at how perfectly First BanCorp checks off the legendary Buffett criteria. Understandable business? Yes. They have what we'd call a narrow note, mainly because the banking market down in Puerto Rico is highly consolidated, meaning competition is just less intense. Plus, they are generating an absolute monster 17.92% return on average equity right now. And management? Well, they're aggressively returning capital to owners with a 92% net payout ratio through buybacks and dividends. That is exactly what we like to see.
And speaking of management, their quality really is exceptional. S&P Global pointed out that they perfectly balance aggressive shareholder returns. They bought back $50 million in stock this quarter alone with a highly conservative risk appetite. They aren't out there chasing risky loans just to juice short-term earnings. They're growing steadily at about 4 to 6%, keeping credit quality pristine, and then handing the extra cash right back to the owners.
Moving on to Section 2, Deep Financial Statement Analysis. Let's see how that great qualitative story translates into hard, cold numbers.
Take a look at these income statement trends. They are phenomenal. We're looking at a 21% year-over-year jump in earnings per share, climbing from 47 cents to 57 cents. Net income hit $88.8 million. But honestly, the real star of the show here is their net interest margin. That's the profit spread between what they pay out to depositors and what they charge for loans. It expanded to a sector-leading 4.75%. While a lot of mainland U.S. banks are currently getting totally crushed by rising deposit costs, First BanCorp is literally expanding its profitability. It's wild.
And if we peek at the balance sheet, you'll see a highly stable $16.6 billion deposit base. It is heavily weighted towards sticky, low-cost core deposits. They rely on virtually zero expensive wholesale borrowing, which, let's be real, has been the absolute kryptonite for so many regional banks recently. In fact, they grew their core customer deposits by over $158 million this quarter alone.
Now, this number right here, 16.93%, this brilliantly illustrates how safe they are. This is their Common Equity Tier 1 or CET1 capital ratio. To put it simply, this is a financial fortress. It is massively above regulatory requirements and way, way higher than their mainland peers. Just for some context, S&P considers anything in the 10 to 15% range as strong. First BanCorp is knocking on the door of 17%. They could absorb almost any macroeconomic shock you throw at them.
So to calculate Buffett's famous owner earnings, we take net income, add back depreciation, and subtract maintenance capex. Since they don't explicitly list maintenance capex in the SEC filings, we're safely assuming it mirrors their $17.3 million credit provision. That leaves us with massive real cash generation. Now, we do have to talk about one red flag. 52% of their deposits are technically uninsured. Sounds scary, right? But as S&P points out, there's a big catch. Those are mostly public sector government funds that are fully collateralized by pledged assets. So the actual risk of a retail bank run? Remarkably low.
All right, Section 3, Quantitative Valuation Models. This is the really fun part. Let's do the rigorous math and find out what this business is actually worth.
Okay, to build our discounted cash flow model, we have to lay out our assumptions. We don't have an exact weighted average cost of capital in the 10Q, so we're going with a standard, conservative 10% cost of equity. For growth, we'll use a 5% base free cash flow growth rate, which lines up perfectly with management's historical 4 to 6% loan growth, and then tag on a conservative 2% terminal growth rate to match long-term GDP.
Running those exact numbers gives us a really fascinating range.
If we look at a pessimistic scenario of just 2% growth, the shares are worth $25. Under our base scenario, projecting that 5% free cash flow growth, the DCF yields an intrinsic value of $30 a share. And hey, if they manage an optimistic 8% growth, the value pops up to $36 a share.
Next up, let's try the classic Benjamin Graham intrinsic value formula. This prices a stock based on earnings, expected growth, and corporate bond yields. It's literally the formula the father of value investing used to hunt down mispriced assets. So let's plug in the data. We annualized their 57-cent quarterly EPS, giving us $2.28. We apply a 6% growth rate, and let's assume a standard 4.5% AAA yield environment. You run that through the Graham formula, and it spits out a staggering intrinsic value of over $45 per share. Think about that for a second. It suggests their current earnings power is just massively undervalued by the broader market.
And look, checking out the market multiples just completely confirms this cheapness. At $24.05 a share, First BanCorp is trading at a PE multiple of just 10.5 times trailing earnings. That is noticeably cheaper than historical industry averages for Puerto Rican banks, which usually command a 12 to 14 times multiple when they're generating returns on equity this high.
To really hammer this point home, we can run a reverse DCF. Basically, we ask the model, what kind of growth is the market currently pricing in at that $24.05 stock price? The answer? Less than a 2% perpetual growth rate. The market is essentially acting like this bank will have zero real-world growth, totally ignoring the massive 21% EPS growth they literally just posted.
Section 4, Margin of Safety. Let's bring this all together. We never want to blindly trust just one model, right? We aggregate them to protect our downside. Now, a strict dividend discount model values the stock way lower at $16, but honestly, that model vastly underprices their heavy stock buyback strategy. I mean, $50 million bought back in a single quarter is huge. So weighting our base DCF and the Graham formula, we can comfortably anchor our most probable intrinsic value right around $32 a share.
But Buffett teaches us to never pay full intrinsic value, does he? So if we apply a strict 25 to 30% margin of safety to our $32 valuation, it gives us a highly conservative target buy price right in the range of $22.40 to $24 a share. And here is the absolute craziest part of all of this, that is exactly where the stock is trading today. It recently closed at $24.05. We have officially found our margin of safety. Finally, Section 5, Final Buffett-Style Verdict. Let's wrap this up.
Okay, here is the summary for the Value Investment Committee. First BanCorp offers a narrow but very durable economic moat in a consolidated market. They generate an incredible 17.92% return on equity, all while maintaining a 16.93% CET1 fortress of a balance sheet. They are growing earnings at over 20% year over year, and the management team is dead set on buying back cheap stock and paying dividends, hitting a massive 92% net payout ratio.
So what's our verdict? It is a clear, definitive buy. Buffett famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Well, First BanCorp is undeniably a wonderful, capital-rich business that just so happens to be trading at a very fair, heavily discounted price.
I'm going to leave you with this final thought to ponder. With such an impenetrable capital fortress, pristine credit quality, and a rapidly shrinking share count thanks to those aggressive buybacks, is First BanCorp the absolute safest financial asset the market is currently overlooking? Take a look at the filings yourself, crunch the numbers, and let me know what you conclude. Thanks so much for joining me on this explainer, and keep on learning.